It's safe to say that it's been a pretty terrible year for investing. Whether you bought ARK Invest ETFs in February, bought Terra Luna right before the collapse, aped all of your money into a meme stock, thought that Bitcoin was going to 100K, or even just bought the broad market like a civilized person, chances are you're sitting on some losses. It happens to the best of us. The good news is we can strategically use these losses to better position our taxable investment portfolios going forward. In this video, we are going to go over everything you would ever want to know about tax loss harvesting. If at any point you decide you like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, if you want some free stuff, feel free to lurk below and check out the links in the description. You can get some free stocks, also a free $30 to sign up with Rakuten, a site where you can earn cash back on everyday purchases. Tax loss harvesting is a strategy used to lower current taxes paid to the U.S. federal government by deliberately selling an investment at a loss in order to use that loss to offset taxes owed on an investment sold at a profit, or even taxes owed on personal income. The investment can be any tradable security, so stocks, bonds, shares in an exchange-traded fund, or even cryptocurrencies. You can only use loss harvesting to offset $3,000 of ordinary income per year, but excess losses can be carried forward to future years to offset gains or to offset taxes owed on $3,000 of ordinary income in those years. This is why it's important to have good accounting procedures so you don't forget about those losses that you took in previous years that you could use today to reduce your tax bill. It goes without saying that tax loss harvesting only works in a taxable account. So if you took some L's in an IRA, 401k, or HSA, you're pretty much screwed. So while tax-free and tax-deferred accounts are incredibly powerful for reasons we've discussed in previous videos, there's also some value in rounding out your portfolio with taxable investments. This can also help for strategically making distributions at retirement, but that's a video for another day. We should also note that the benefit of tax loss harvesting is tax deferral, not tax cancellation. In other words, harvesting a loss generates current tax savings, but you're likely taking that money and buying something similar when the market is down, and thus buying at a reduced cost basis. This sets you up for a larger potential capital gain in the future, but because of the time value of money, we're happy to take that tax savings now, have more money to invest now, and pay the taxes at a later date. But just to play devil's advocate, you could imagine a situation where an investor defers taxes to the future with loss harvesting, and either tax rates go up or they find themselves in a higher tax bracket when they do have to pay the taxes. So nothing is perfect. There's always ways to lose here. But let's go over an example. Let's say you have $20,000 of capital gains on investment A. Investment B is sitting at a $25,000 loss. You can sell investment B to offset taxes owed on the $20,000 gain from investment A. You still have $5,000 of losses left over. You can use $3,000 of those losses to reduce taxes owed on $3,000 of ordinary income. And then you have $2,000 of losses left over to offset next year's gain or income. At the 35% marginal tax rate shown in this example, this would be a tax savings of over $8,000. So instead of paying that money to Uncle Sam today, the investor gets to keep the $8,000 to continue growing their portfolio. It does get a little bit more complicated when we consider long-term gains, short-term gains, long-term losses, and short-term losses. Remember, you get taxed at the more favorable long-term capital gains rate when you sell a security after holding for more than a year. Short-term capital gains are gains taken after holding for less than a year. These are generally taxed as ordinary income. Anyway, a long-term loss would be first applied to a long-term gain, and a short-term loss would be first applied to a short-term gain. If there are excess losses in one category, these can then be applied to gains of either type. This is enough to make our head spin, but the bottom line is that short-term harvesting losses are generally more valuable than long-term losses when tax loss harvesting. Alright, so you're all excited to start tax loss harvesting. Why not just sell your investment, realize the loss, and then immediately buy it back? Not so fast, because there's something called the wash sale rule. If this is broken, the IRS will disallow the offset of capital gains. The wash sale rule states that an investor cannot realize a loss if, within 30 days before or after this sale, the investor buys the same or a substantially identical stock or security or acquires a contractor option to do so. So you can't just sell and buy right back. But I do want to reiterate, the wash sale rule applies to 30 days, not just after, but also before the sale. People forget about the before part. So you can't just buy new shares and then immediately sell off your losing shares. The wash sale rule also applies to different accounts with different providers. And it applies to not just taxable accounts, but also to 401ks, IRAs, and HSAs. If you're married, it also applies to your spouse's accounts. So you start to see how this can get very complicated and very messy. So while you could sell a stock in your Vanguard account and immediately buy it in your Fidelity account, neither brokerage would flag this as a wash sale, but it would technically be tax fraud. So you have to be careful. Just because someone on the internet said they did something does not mean that you can do it. Remember, everything is tax deductible until you get audited and you get caught. So it's best to not mess with the IRS. If you would have a hard time explaining an action sitting across the table from an IRS agent, then it's probably best to not do it. But of course, consulting with a tax professional is always the right move. One thing to note, although cryptocurrency trades must be reported on tax returns as capital losses or capital gains, the IRS still considers cryptocurrency as a property rather than a security, at least as of 2022. So the wash sale rule does not currently apply to crypto. You can sell it, realize the loss, and buy it back immediately. But this rule will almost certainly be going away soon, so please double check this whenever you watch this video or ask a CPA. So let's talk about the substantially identical terminology in the wash sale rule. Because let's be honest, nobody wants to sell at a loss and then sit in cash for 30 days. A lot can happen in 30 days. People want to keep their money working by investing in something else. Often some of the best days in the market come after some of the worst days in the market. So if you sold at the bottom, sat in cash, and then the market rallied 20% in a month, that would really hurt. The wash sale rule does not clearly define what would make a replacement security substantially identical to the one sold to harvest a capital loss. This is obvious when it comes to stocks, because no stock is identical to another, except for maybe something like Google Class A shares and Google Class C shares, GOOGL and GOOG. I actually couldn't find any information on this, but I personally would not feel comfortable loss harvesting these. They seem pretty much substantially identical to me. But for most stocks, it's pretty clear. For instance, we sell Coke at a loss and buy Pepsi. These stocks are in the same business, but they aren't substantially identical. Kind of like when you ask for a Coke at the restaurant and the waitress says, "Is Pepsi okay?" It's not the same, but it's close enough. But that aside, the substantially identical clause becomes much more murky as it pertains to ETFs. For instance, if an investor were to sell VOO and buy SPY, it would be hard to argue that these are not substantially identical. Yes, they're different ETFs from different providers, but they track the same index, the S&P 500 index. As you can see, they overlap 99% by weight. But if an investor were to sell VOO and buy VTI, the Vanguard Total Market Index Fund, this is a different ETF that tracks a different index. As you can see, they only overlap 85% by weight, so similar but not identical. So tax loss harvesting is a pretty good deal with ETFs and mutual funds because you can move your money into something similar but not identical, and therefore have similar upside exposure if the market rallies within that 30 days. So you don't have to kick yourself for selling at a low and then watching the market go to the moon. But it can be a bit more tricky with stocks because, again, you're intentionally selling at a low. If it's a stock that you've given up on and you believe it will go lower, so it's not much of an issue. But if that stock is a stock that you believe in and you want to get back in, you're taking the risk that that stock can moon right after you sold it, and the stock you bought could tank immediately. That's less likely to happen with ETFs that have some overlap. But let's say you want to tax loss harvest Shopify stock and get back in after 30 days. So where do you park that money? I don't know, Amazon, Etsy? Yes, they're other e-commerce stocks, but they're different companies and they'll trade differently. Shopify could report better than expected earnings right after you sold it, and Etsy could report worse than expected earnings right after you bought. So maybe the move is to park the money in a consumer discretionary ETF or e-commerce ETF. This still provides exposure to the sector but without the volatility of moving into another stock. So maybe this is an argument for keeping individual stock trading in tax advantage accounts and keeping ETFs in taxable accounts. But someone else could argue that the increased volatility of the individual stocks over ETFs will give you more opportunities for loss harvesting and thus should be kept in taxable accounts. Nobody ever said this wasn't complicated. When it comes to loss harvesting, it pays to have a brokerage that allows you to sell specific shares of a stock or ETF. In this case, you don't necessarily have to be all in or all out of a stock to get the benefits of loss harvesting. You get to hang on to the older shares that you may be up big on and get rid of those newer shares that maybe you bought when the market was at a peak. So that's it for this video. If you found this helpful, consider hitting the like button and subscribe for more content like this. Again, also consider checking out the links down below. Currently down there, you can get 2 free stocks of Webull, potentially valued at $2,300, $30 with M1 Finance, and $30 with Rakuten, a site where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial or tax advice, just entertainment purposes only. So thanks, and I'll see you in the next video.